Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. WCICon 25 starts in just a week, and this year it's being held in San Antonio, Texas. I'm honored to be speaking there. For the third year in a row, I'll be speaking on index fund investing. If you're going to be at the conference, I'd love to meet you. Please come and find me. For now, we're going to switch gears and talk about real estate investing. It's been a while since I did an episode about investing in real estate, so I thought I'd talk about the easiest way to include real estate in your investment portfolio. It's likely it already occupies at least a small percentage of your current investments. That's because there's publicly traded real estate companies that are included in many total U.S. stock index funds, including Vanguard's FTSAX and VTI, Fidelity's FSKAX and FZROX, and Charles Schwab's SWTSX. Even if you only have the S&P 500 index, there are publicly traded real estate companies there as well. Real estate represents around 2.5% of the total U.S. stock market. Publicly traded real estate gives you a way to invest in real estate through buying stocks. This gives you a way to invest in real estate in a highly liquid manner and with the least amount of hassle of all real estate investing. There's really no other way to invest in real estate that gives you high liquidity and diversification with a low entry level of investment. And frankly, you can also start investing without any real expertise in real estate, which I would not recommend for just about any other way to invest in real estate. It's as passive as you can get with real estate investing. On the flip side, it does give you zero control. The only control you have is what companies or funds you invest in, when you buy shares, and when you sell them. You can't add value in any way. You don't have the ability to give input, much less make decisions. You also don't get any of the tax benefits around real estate investing that occurs with other methods of investing in real estate. Publicly traded real estate stock is also more correlated with the stock market than with the general real estate market. Any factor that affects the overall stock market can and will affect the value of real estate stocks as well. The historical correlation of publicly traded real estate with the U.S. stock market has been somewhere around 0.5 to 0.6. In comparison, the long-term average correlation between the U.S. bond market and the U.S. stock market has varied between minus 0.2 and positive 0.2, meaning that there hasn't been that much correlation with each other. Most, but not all publicly traded real estate companies are REITs, which stands for Real Estate Investment Trust, REIT. These companies exist primarily to own real estate and must pass 90% of its net income to the investors. Some of this is return of capital, which is not taxable. This is basically how REITs pass depreciation on to its shareholders. The taxable portion is taxed at ordinary income tax rates, not qualified dividend rates like most stocks. REIT dividends are paid with a 1099, not a K-1. REITs are pretty tax inefficient as far as stocks go, making them potentially better held inside of retirement accounts or other tax-advantaged accounts. A publicly traded REIT is an individual company, but that one company could actually own thousands of properties. There are about 225 publicly traded REITs on the U.S. stock market currently, though this number does fluctuate. REITs make up about $1.37 trillion of the U.S. stock market. There are also public non-traded REITs that are registered with the SEC but don't trade on the stock exchanges. These are less liquid but also have less market volatility because of their less liquidity. They can be purchased through a broker or financial advisor who participates in non-traded REIT offerings. Private REITs aren't registered with the SEC and don't trade on security exchanges. Generally, their shares are sold to institutional investors only. When you start investing in REITs, it's probably best to stick with publicly traded REITs. Congress established REITs in 1960. For a company to qualify as a REIT, it must invest at least 75% of its total assets in real estate, cash, or US Treasuries, and derive at least 75% of its gross income from rents of real property, interest on mortgage financing property, or from sales of real estate. REITs must pay at least 90% of its taxable income in the form of shareholder dividends each year. REITs are taxed as a corporation and are managed by a board of directors or trustees. They must have a minimum of at least 100 shareholders, and a REIT can have no more than 50% of its shares held by 5 or fewer individuals. There are 3 basic kinds of REITs: equity REITs, mortgage REITs, and hybrid REITs. The majority of REITs are equity-based and own and manage income-producing real estate. Equity REITs generate the majority of their revenue through rents. Mortgage REITs lend money to real estate owners either directly through mortgages or indirectly through acquiring mortgage-backed securities. Mortgage REITs generate revenue based on the interest charged on the mortgages, minus the cost of funding these loans. The third type of REIT, hybrid REITs, own property and hold mortgages, though this strategy has fallen out of favor after the 2007 to 2008 financial crisis, so there are very few hybrid REITs currently. If you already own REITs within your total U.S. stock funds, why invest more in REITs? One reason to consider this is that most real estate is not owned by publicly traded companies. If you measure companies by the amount of profit, about half of businesses are publicly traded. Compare that to real estate. The total value of U.S. real estate is estimated to be around 60 to 70 trillion US dollars. Residential real estate makes up about 44 to 55 trillion US dollars, and commercial real estate around 15 to 20 trillion US dollars. The total market capitalization of all U.S. REITs is approximately 1.5 trillion US dollars, which is 10% or less of the U.S. commercial real estate by value and less than 2.5% of the overall U.S. real estate market. This means in terms of total value of the U.S. economy, real estate is underweighted when it comes to the publicly traded market. Unlike investing in an individual stock of most businesses, when you invest in an individual REIT, you are investing in a diversified portfolio of real estate. That implies that there's less risk when investing in an individual REIT compared to an individual stock. If you want to invest in a specific type of real estate market, you can do that by investing in an individual REIT. One example is Vornado Realty Trust, which is a member of the S&P 500 and one of the largest REITs in the United States. Vornado primarily invests in New York City offices and Manhattan street retail. So if you're interested in investing in New York City because you think it's really going to do much better now that more companies are requiring their employees to return to the office, this could be one way to do that. If you're interested in finding a REIT for a specific real estate sector or location, you can look at information from NAREIT, N-A-R-E-I-T, the National Association of Real Estate Investment Trusts. They have divided real estate into 13 sectors: gaming, office, industrial, retail, lodging/resorts, residential, timberland, healthcare, self-storage, telecommunications, data center, diversified, specialty, and mortgage. Look at industry trends to determine what type of REIT you would want to include in your portfolio. There are some areas of real estate that have not been doing well. For example, mall traffic has declined with the increased popularity of online shopping, as well as took a big hit during the COVID pandemic. Commercial office space was also hurt during the pandemic, with more people working at home or doing telework. But with more return to office mandates, office real estate may be on the upswing. Different real estate sectors will have different potential benefits as well as risks. Residential real estate has stable demand and tends to be recession resistant, but it's also sensitive to local economic conditions and the potential for rent control laws. You'll want to consider the risks and benefits of any sector where you are considering investing. If you are looking at investing in an individual REIT, look for growth in earnings, which indicate higher revenues from higher occupancy rates and increasing rents. Look at debt levels as well as dividend history. Research the management team that oversees REIT properties. REIT management fees are built into operating expenses, which affect overall returns. Review how comparatively efficient the trust is when managing its expenses, which is essentially what your fees are. You can also invest in REIT mutual funds for more diversification. There are both actively managed REIT mutual index funds and passive REIT index funds, which own shares in every publicly traded REIT. Vanguard REIT index funds invest only in equity REITs, not REITs that hold mortgage or debt. It has a traditional mutual fund version, VGSLX, and an ETF version, VNQ. Fidelity Real Estate Index Fund is another option. There's also a Schwab Real Estate Index ETF and an iShares Real Estate Index ETF. There are also international REITs and international REIT mutual funds as well. One thing to consider is that some REIT funds can have a top-heavy structure, where a small number of large REITs dominate the portfolio's holdings. For example, major players like American Tower Corp, AMT, Equinox Inc., EQIX, and Prologis Inc., PLD, often comprise a significant part of these funds. This could mean that your returns depend heavily on just how a few large companies perform. Consider actually looking at the holdings of any REIT mutual fund that you're purchasing and see how diversified that fund really is among different REITs. The return of REIT index funds has paled in comparison to the return of the US stock market in recent years. However, because REITs must return 90% of their taxable income to shareholders, it is a good source of steady cash flow without having to actually sell shares. This makes REITs potentially a good opportunity to hold in your traditional retirement accounts. Within those accounts, you don't have to worry about the tax inefficiency of REITs, and then you can withdraw the dividends without actually selling the shares you own of the REITs in order to have income. Regardless of whatever funds you're pulling out from your traditional retirement funds, you'll end up paying ordinary income taxes on those funds anyways. REITs are the easiest way to invest in real estate. It provides high liquidity, diversification, and a low barrier to entry. While REITs haven't had the growth of stocks, it can have attractive risk-adjusted returns with steady cash flow. REITs can be a good addition to your current investment portfolio or something to consider for your investment portfolio when you're at the point where you're withdrawing from a traditional retirement account. That being said, REITs should likely still make up a minority percentage of your overall portfolio. If you are someone who would like to have a little bit more real estate exposure and don't want the hassle of more active real estate investing, REITs can really potentially be a great investment to consider. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. I'm always open to feedback on what topics you'd like to hear about on this podcast. Feel free to reach out to me at growyourwealthymindset@gmail.com. If you've been loving this podcast, I really encourage you to spend a moment and write a 5-star review. I really appreciate it. Thank you so much for being a listener, and I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.